We're officially back because we are on YouTube for the Thursday edition of the Not Your Average Investor Show, the JWB Week. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flows. He's a great co-host, and his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And back from a Hawaiian vacation is the one that we call MTM because she brings us the moments that matter, and because her name is Madison the Magnificent. Say hello, Madison.
Hi, everybody.
And, you're joining us on YouTube, watching live, or maybe you're watching the podcast, or you're listening to the podcast sometime here next week in the future, or you were watching the YouTube replay. A little piece of advice. We got a full community in the house that's checking in already, people that want to be your friend and help you on your real estate journey. And all you got to do to join us is go to NYAIS.com. Put it on your calendar, show up to one of these lives one of these days, make a friend in the chat, or just join our Facebook group and be part of what, GC?
The roll call, baby.
The tradition we like to call the roll call. We got Danny Davis kicking us off with a Guten Tag. We got the MVP in the house.
Lee Bishop.
Back to
and I do want to do a salute to Denny Davies. You weren't on the show last Tuesday, but he suggested that every military family, especially Denny Davies and his family, being military, that we give a little salute.
All right. Salute, Denny Davis.
Salute to
Guten
Denny
Tag and salute and tag.
Thank you.
We got our leadoff hitter.
That would be John Henning.
John Henning batting third today with a good afternoon. We got Big Papa. We love it when he calls in Big Papa.
It's my dad, Jay Cohen.
Jay Cohen in the house. We got Joe Bussy. Joe gave me a nickname last time around.
Oh man, what
and
was
that? And then I went to Louisville and I completely found I completely messed up.
Like something with Joe in it or something, right?
Joe.
Sure, he'll fill us.
We'll fill us in. All right, let us know, man. We got Joel Wixel in the house from Santa Barbara, California. Is that a new name, Joe?
New name?
Joe?
New name.
Welcome to the show, Joe.
Welcome to the party,
man. Welcome to the community. We got Leo Barraganan.
Barraganan.
Good morning, all from Sunny Bay, California. Good to have you back in the house, Leo. Let's rock for sure. We got Danette Colvin back in the house from Baltimore, Maryland. Good to have you. We got our regulars, the second family of the Not Your Average Investor Show, Gary and Rosalind Riley. We welcome
really
you
know
to
what to do with the second family.
All right.
Welcome.
All right, we got the first family, Ken and Carolyn Moline, the matriarch and the patriarch. Ooh, we salute you. We got Big Ernest Opperly in the house. Good to have you back in here, Ernie, and his lady friend, our favorite name to pronounce, Aaron O'Neill.
Into the lights.
Good to have you. Eddie Harris from Atlanta, back in the house as well. We got a Not Your Average Guest checking in. That means that you checked in from the text message blast. We love seeing that. We try to make it easy. But if you come in from the text message, your name says Not Your Average Guest. So I don't know who you are, which is why I can't say your name. We got Dejav Speller in the house.
You're going to get this. This is my boy, Dehav. Javier, one of my friends from 20 years ago and one of our clients as well.
Dehav from Indy. Love it. Joe B1 Kenobi is
right.
Joe Bussy. Joe, it might take me two more, but I'm going to get it. I promise you, buddy. Joe B1. All right. We got Terry Ingram in the house from Orlando. Welcome back.
Terry's becoming a regular.
Yeah, Terry's becoming a regular. We got the karaoke witness.
Deborah Schwartz.
Deborah, good to have you back. We got Mark Mills checking back in. Good to have you back, Mark. And Michael Santorios.
The referral machine.
The referral machine, the referral robot. Michael Santorios, welcome. All right, we got a couple of Q&As here in the house, and normally right now is when we go to Madison shares good news, but we're going to take this moment to talk about something really important that's happening. Greg, I'll let you talk about it.
Yeah, guys, this is a moment to talk about something, as you mentioned, that's really important and something that would love to ask for your love, support, and prayers for. We have a teammate named Alberto, and Alberto just recently was diagnosed with cancer. Is diagnosed with colon cancer, and he is going to be focusing on his health and has to resign from JWB. And he could really use our love and support. So wanted to bring this to the community and ask for all of you to share in that support. We set up a GoFundMe page and would love for everybody to help Alberto. We set this up yesterday and we just presented it to the team, and we asked the team to jump in and support. And we set a goal, as we always set a goal, to raise $2,500 to support Alberto. And we have already raised over $3,000 with our team. And that's before bringing it to anybody else outside of our team. And so I think we have an opportunity here to make an impact in somebody who is very near and dear to us here at JWB, somebody who cares a tremendous amount about you all and has worked so hard to help you. He's on our maintenance team. but he really needs our help right now. So I wanted to encourage all of you, if you can, to support in any way that you can. We have this GoFundMe page set up. You just go to jwbrealestate.com/Alberto, jwbrealestate.com/Alberto, and just lean in and do whatever you can, whether that's prayers, whether that's support, financial support. Of course, that would help Alberto in this time with him being the breadwinner in his family and needing to focus on his health right now. So thank you guys for every time we come to you with something that's really important for you guys leaning in, and this would be a time to really lean in. So thank you guys.
Pretty cool to see the team support so heavily, man. It's pretty moving stuff, man.
Yeah.
But, prayers, vibes, whatever you got, right? Like send some goodwill his way. If you can donate a little bit. I've seen the cancel struggle from behind the scenes. It's not a cheap struggle, and replacing that is hard. So, all right, we will continue with the show and hope that Alberto and his family, can heal from this and move forward together.
Amen, brother.
Yeah. So John Henning, before we go to the property, John Henning has a question here in the Q&A, and he asks, can Gregg speak about the new mortgage fees, LLPA, and credit scores and how it will affect investment loans?
Man, that's a change of the whole brain patterns right there. Let me get to mortgage fees there.
Okay.
John, I'm not familiar with LLPA, so I can certainly do some research on it. So let me write that down, get back to you on the next week's show.
Is this the thing? I've seen like these memes about like how now people with higher credit scores are going to have to pay some kind of fee and people with lower credit scores don't. So like, it's like, we're penalizing good behavior. Is that what this is?
I'm really unfamiliar. I don't know.
Okay.
Yeah, I'm unfamiliar, but if anybody has a link to the article right now, you want to post that, maybe we can, decipher it on the show, or I'll make sure I get you a good answer next week.
We'll make a Not Your Average Insights about it for sure.
Mm-hmm.
Yeah. John Henning says that's it, Pablo. Yeah, we should definitely dive into that. We'll do a Not Your Average Insights about it. I've been gone at a conference for 4 days. I don't know where I'm standing right now. So I'm just kind of swooping in here, and we promise to come back with the hard-hitting current news.
There you go.
For the community. All right, cool. Denny Davis also says, Gregg, I was actually suggesting you do a tip of the cap to the second family, the Rileys, as their intro. Not really a salute, but a solid knowledge. So tip of the cap. We also do tip of the cap to
Peter James.
To Sir Peter James.
Sir Peter James.
So we got to come up with a different one, Denny. I appreciate the help. And we'll still do the military. We'll do a salute to the military mentions. We got to figure out something for the Rileys.
Love it. Sorry for screwing that up, Denny.
All right, man. Cool. Let's magically, what we came here for, right? Let's check out this POT dub, this property of the week. Magically whisking ourselves away here to 2174 Kistler's Ridge Way, Jacksonville, Florida, 32218. It's got a $275,000 purchase price. It's got a $1,760 in monthly rent. We got a 4-bedroom, 2-bathroom, 1,400 square foot. Finished construction status. Looks like new construction, right? If I'm not wrong.
That it is.
Average duration stay, because if you're betting on a great team, it's 4.5 years. And of course, best in class appreciation for cash flowing markets of 4.6%. But what the investors really come for here, when you are not average, you're asking IRR, and the IRR that you are being promised here, or you're being offered here, is 12.66%. A lot to love here, especially when JWB clients have earned 79% more home price appreciation than the average Jacksonville investor. But GC, what do you love about this property?
Thought you would never ask, Pablo. Literally never. I've been waiting weeks for you to ask me this.
Took me a while.
Goodness. I'll tell you what I love about this property. So beyond the IRR, which is the first thing I always want you to pay attention to, we're going to focus on the neighborhood that this property resides in. This is located in one of 4 JWB neighborhoods, the same neighborhoods that I own my rental properties, the same neighborhoods we've been investing in and all of our clients have been investing in since 2006. Are these 4 neighborhoods, and they're chosen for a reason. One of the main reasons is because they are located next to a ton of jobs. You need jobs so your residents can afford to pay rent. And when your residents are paying rent and you have a wonderful vertically integrated team on the property management side, then you can have a great investment that you can hold on to for a full market cycle. So this is located on the west side of Jacksonville. I just wanted to go through some of the major job creators that are located here within just a few miles. Many of these job creators are located next to the property here on Kistler's Ridge. We've got the main Navy base here in Jacksonville. It's called NAS Jax, Naval Air Station Jacksonville. And we have over 20,000 jobs right there. It's literally right on the west side of Jacksonville. We have multiple Amazon distribution facilities. Amazon is now the #1 private employer in the city of Jacksonville, over 5,000 jobs.
That's what happens when you're a big logistics hub, huh?
That's right. And that's all since 2017, by the way. That was the first time that that Amazon built a distribution facility here in Jacksonville. Now they have 12-ish or so facilities here in Jacksonville, and large success story. And a lot of their facilities are here on the west side, which is, again, just a few miles away from this property on Kistler's Ridge. Another huge concentration of jobs is Cecil Airport. Cecil Airport has some of the biggest names that you'll find in aviation and engineering. So Boeing, Embraer, Flightstar, Northrop Grumman all have facilities and jobs that are there at Cecil Airport, which is, again, just a few miles away from Kistler's Ridge. Florida Blue even has a call center at Cecil Airport. I didn't realize this. Florida Blue has a call center at Cecil Airport, which employs over 1,000 people. Right there. That's
right. Cecil Airfield. That's the airfield that we covered on the show.
Mm-hmm.
It's the only horizontal takeoff space exploration airfield approved in the entire Eastern Seaboard.
Exactly.
Not a bad
for commercialized space travel.
Not a bad place to be.
Yeah. And we haven't even began really to see the impact on jobs and economics from that type of commercialized space travel, where we're putting horizontal launched satellites into the space or whatever. I don't understand it all yet, but there's going to be an impact of that, which I'm sure we'll detail at some point in the future. So lots of jobs here on the west side, low prices, high rents, surrounded by jobs is the formula for success in owning rental properties. And that's why I love this property here on Kistler's Ridge.
And, that to me speaks up. Right. So you mentioned a couple of things, the airfield, the Amazon centers, and the Navy, right?
Mm-hmm.
Like logistics and government, right? Yeah. Just very, very stable economic sectors that don't fluctuate wildly. It's very tangible.
It's not leisure and travel and tourist based.
Correct. And I hear workforce jobs.
Yeah, exactly.
Right. The people that can't necessarily afford to buy a home in Jacksonville, but will want to rent a comfortable place for them and their kids to be able to thrive.
Exactly. You're talking $50,000 a year jobs ish, 55,000, maybe $60,000 a year jobs. Those are perfect jobs with large companies like that. Those are perfect jobs to have and for our residents to have. They support the rental income, which at the end of the day that you need that to support this great investment.
That's awesome, man. That's cool, man. That's a lot to love. 12.66 IRRs, purchase price of $275 GC. Is this kind of like where inventory is these days? Can you tell me just kind of like representative of what's out there for an investor?
Yeah. So if we start to think about the neighborhoods that we're going to play in, these workforce housing neighborhoods, we're going to be at, call it median home sales price and slightly below that, right? So the median home sales price in Jacksonville, around 340-ish, somewhere around there. And so 275 is below that median home sales price. You want to be below that median home sales price because that creates the best risk mitigated returns on investment. So yeah, and then you're throwing new construction in. New construction will be towards the higher end of that spectrum for us. So yeah, 275 is pretty normal when it comes to new construction homes. And, when you invest in a new construction home like this, you tend to get a higher rent as well. So that 1760 is near the higher end of the rent scale for us as well. And then this project here on Kistler's Ridge is one that we took down and probably have sold somewhere around maybe 8 to 10 homes, all here on Kistler's Ridge in this neighborhood. And so it's one that we have a lot of familiarity with. There are a lot of homes that are already rented, and this home is already rented. We just took a lease, which has been approved, and the resident is waiting to move in. They're expected to move in within the next 2 weeks. And this resident is signed up for a 3-year lease. So a lot of variables that people usually have when it comes to investing in rental properties are taken off the table with this asset. Many people don't know the right market to go in. Many people don't know the right neighborhood to go in within that market. And then even if they choose the right neighborhood and the right market, Then they're concerned about what rent might really be in that area. Is there enough rental demand? Well, there's 8 to 10 other examples of homes that are already successful with long-term leases in place. And then this is that production line. It's just adding another asset there. And so hopefully it gives you a lot of confidence.
Everything that you just said for me pings risk mitigation, right? The idea that it is below median price, right? So still in a affordable range. The fact that it is workforce housing, right? This like very stable sector of the economy that either gets demand from people looking for their first, rental home, or people that are having to downsize or whatever because the economy is tough, right? Like a very insulated thing. The idea that it is located around a whole bunch of other homes, that you have a completely stabilized data set to really understand how this thing will perform based on your team's proprietary capabilities.
Mm-hmm.
The fact that it's already rented with a renter in place, right? Like, what am I missing? Like, it all just screams basically risk mitigation, right?
Yeah.
Yeah.
And you start to think about, as long as we've been doing this show for 3 years,
Mhm.
right? You go back a year ago, 2 years ago, the risk that you had was more prevalent in certain places, right? You had construction risk. You didn't know how long the home was going to take to be finished,
Yep.
right? And guess what? Construction timelines went over, right? People, JWB clients, many of you have experienced this. If you bought a house a year ago or 2 years ago, you put it under contract, and we waited 3 months or 6 months until that home actually was completed.
Yeah.
Now, you weren't on the hook for overages on the construction cost, so you didn't have that risk. But as far as, risk to actually completing the asset, there was that risk. Then when you got to close on the home, we didn't have time to fill it with a resident at that point, because we closed as soon as the home was completed. So there was some risk that was involved there as well, where the home was not cash flow positive day one. That's because of the crazy market that we were in. It just, so many people were buying homes that they were buying them before they were, completed. So for you as an investor, now you have a lot of these capital preservation, this risk mitigation built into the asset today that you didn't have on the cash flow side, even a year ago or 2 years ago. And it's just a great thing to walk into, where that it's already rented. It's rented for a long time. It's in a neighborhood that's already shown success. So there's a lot to love on the risk mitigation and defensive side of this.
So that's the risk mitigation defensive side of it, right? That is if we go into your tenets for investing right now, it's turn equities into income.
Preserve capital, beat inflation.
Preserve capital, beat inflation. Let's talk about the beat inflation side. So this like 12.66% IRR, that's over 10 years.
Mm-hmm.
I think it's as good a time as any to kind of just go over the 5 profit centers, I think.
Love that.
Yeah.
And we should just kind of point out, sometimes when we talk about returns and we say things like over 10 years, somebody might think that they're earning 12% total over 10 years. That's not actually the case. It's earning 12.66% every year over 10 years.
All right. That's a new thing for me.
Yeah. Yeah. It's something that we just talk about it, and one little term can change the impression for people. So this is you earning 12.66% on your money every year on average over a 10-year hold.
Got it.
Which is awesome.
That sounds awesome. Does that mean that it's compounding year over year at that 12.66%?
Yeah. What you actually do to figure out the IRR is you look at the timing of when the cash flows come into your bank account and the amounts. And then what you figure out is the discount rate that would have made the value of the net present value of your future incomes equal to it. So it's what it does in layman's terms is it takes your every cash flow that comes to you on an annual basis. Some are small, right? In the beginning, your cash flows are relatively small. When you sell the asset after appreciation and principal pay down and all of these other profit centers work in your favor, you get a large windfall. And so if you look at your return on investment year over year, your return on investment that last year is like ginormous because you get this huge windfall, but that's not the right way to do it. What you do is you want to take an average of the returns on investment over the 10 years. And then as an investor, you're saying, well, this helps me make decisions. If I put my money here, or if I put money there, on average, I would have earned this return here or there. And that's how you can compare apples about your investment options.
Apples to about the investment options.
There we go. Write it down.
All right. So 12.66% every year is equivalent to, if you were to purchase this property today and sell it in 10 years, that would be what it would come down to, because you've discounted exit costs and blah, 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 blah. If you hold this thing for 30 years, you hold it even longer, then things get really, really interesting in the sense that it just continues to get more cash flow. It continues to appreciate more. You're able to take out equity from the property and invest in other properties, like a bunch of our community has done, right? Like turn 2 or 3 of these
100%.
into 6, which I plan to do sometime soon here in the near future. So that is kind of like the overall picture. The 5 profit centers, GC, we haven't gone through it. I see a bunch of new names in the chat. So
absolutely.
I'd love to just kind of hit on the 5 profit centers.
So the first one that most average rental property investors look at is net rental income, which we love net rental income. Net rental income is all about risk mitigation. That means that you have enough money coming in from rents to cover the expenses that happen every single month. And we love that. So that is one of your profit centers. And then we have tax savings, which is another incredible profit centers. Tax savings don't give as much love. They don't get as much love as net rental income. Nothing really does.
You give them a lot of love.
I love tax savings. I love tax savings. But these are the special advantages that you have from a tax savings perspective, simply because you're investing in an asset like a single family rental property. Everybody who's listening here, live on the show and the podcast, or wherever on replay, you all are able to take advantage of this tax savings. And you don't get that tax savings when you earn the same amount of money in the stock market or in bonds or in most other asset classes. You don't get it. So that equates to thousands of dollars over a full market cycle for you. Then you've got principal pay down. This is this beautiful concept of your resident paying your loan down for you, which when you invest in an asset that is cash flow positive, that has positive net rental income, it's another way of saying that, your resident is actually paying your loan down for you in that mortgage payment every single month. And that equates to tens of thousands of dollars over a full market cycle hold. Again, most people never think about it. And then you've got home price appreciation, which a lot of people think about home price appreciation, but they don't really understand how to evaluate it. And over a full market cycle, home price appreciation is cyclical. It is something you can count on over a full market cycle, which is known to be between 10 to 20 years. And that's because if you go over and look past the last 10 years or the last 20 years, and you break it down into 10-year increments of time, home prices tend to appreciate the same amount for your market that they did on average over the last 40 years. And it'll happen the same way over the next 10 to 20 years. So you can count on home price appreciation. And the reason that's so important is because if you look at all of your profit centers, the number one contributor to your total return on investment will not be net rental income, even though most people pay attention to that only. It will be home price appreciation. It accounts for 60 to 80% of your total pie of return on investment.
It is the Pac-Man of the pie.
The Pac-Man of the pie. There we go. Trademark that.
TM.
And then the last one is inflation hedging, which for so many years, most people didn't talk at all about inflation hedging. Most people didn't talk about inflation at all, but that is the topic du jour. That's the topic of the day.
The topic of the day. Oh.
Inflation's raging in our country still. We are happy that it has come down to 5%, but that's still, more than double what it should be. That's 1.5 times what the mandate should be from the Fed. And so we have a long way to go to get inflation down. When inflation is raging like it is, you want to be in assets that hedge against inflation. That means that the asset tends to perform well in an inflationary environment. And single family rental properties do that. And one little tidbit on the inflation side, when you take out smart debt in an inflationary environment, you're the big winner. That's how you profit from inflation. So those are your 5 profit centers. You got net rental income, tax savings, principal pay down, home price appreciation, inflation hedging. There you go, brother.
Nailed it, bro.
Hey,
I would have bet an over 7 minutes on that explanation, and you nailed it in like 3.5. That was, I don't know.
You encourage the things you want to continue, don't you? I see what you're doing there.
Just a positive reaffirmation here. A couple things, right? So if you are a fan of the show, you've been listening closely, you know that GC and I are working on a class.
We are.
Not Your Average Investor's Guide to Rental Property Investing. And as I'm like naming the different segments, inflation hedging, I named voted most popular profit center of 2023.
That's
right. Because it is a conversation that we really weren't having in 2020, 2021, started ramping up in 2022. And now it's at a nice crescendo, kind of an abstract thing, but makes a ton of sense when we're in this kind of environment.
Right.
From recording the classes, and I've been reviewing them, right? Tax savings, principal pay down, not the sexiest stuff,
right,
but also very underestimated in the sense of like, when you're looking at this thing, you're not taking into account the tax savings, you're not taking into account the principal pay down. That really high floor
right,
of your rich uncle paying off your loan for you is super awesome. And then we get to the big boys, right? Like the main event, that's like the undercard in the fight card.
right.
And then the main event is cash flow and home price appreciation. A couple of things to recap. One is the idea that cash flow is risk mitigation, right? Like the idea that cash flow, as long as you're having positive cash flow, this becomes a much more scalable asset for you. Because if you're not having a dip into your pocket every single month, you're more likely to add other homes that continue to build your wealth and continue to allow you to be a financial engineer that we like to talk about. And then the idea that home price appreciation is often misunderstood.
Mm-hmm.
Everybody marked by the Great Recession believes that home prices tend to go up and down. They generally don't, but really what they definitely don't is over a long period of time, right? If you're in it for a full market cycle, you can truly count on the historical home price appreciation to play out.
Mm-hmm.
And when you do that and you use leverage and stuff like that, you start to see the idea that when you break it all out into a pie, it is a Pac-Man is home price appreciation, and then the mouth of the Pac-Man, the little slices of pie that you're serving people are the other profit centers, right? But like this idea that people overvalue cash flow for its return as opposed to its risk mitigation aspect, and undervalue home price appreciation because they don't understand home price appreciation is one of the big things that we taught.
Yeah, and I would say it's slightly different. I would say that people demonize the lack of life-changing positive cash flow as the reason to not invest in this asset. They may say, oh, I'm only getting $50 a month in positive cash flow. Why would I do this asset? And they're missing the big picture. So I think that's even more prevalent. They latch onto that and they say, oh, well, it's only $50 a month in positive cash flow. That's not as good as a bond, or why would I do that when I could just go put that in the stock market? And they're just missing out on, as we talk about, over 60 to 80% of the total pie. They're missing out, and they're taking the one small piece of it and saying, well, that's not enough. That doesn't make a whole lot of sense to me.
Yeah, totally, man. And we've definitely proven the fact that that's where the juice really comes from, right?
Mm-hmm.
Michael Santorius has a question. He went to jwbinventory.com. He downloaded the sheet, which you can do if you're following along at home. And he says, looking at the numbers on this property and comparing what I'm paying for in my new construction on the west side, $585 for insurance seems a bit low. What are your thoughts on that, JC?
Well, the insurance for this home on Kistler's Ridge has been quoted right now. So that's an actual policy that has already been quoted, and the client who buys this property will be able to secure that quote. So I know that that's accurate for Kistler's Ridge. Michael, for yours, insurance can change on different properties, different neighborhoods and things like that. So, I would go back and look at your specific property. And if you have questions, reach out to the team here, reach out to the Ritchie Insurance Group if that's who you are using, as most of our clients do. And I would say take an in-depth look at your property to see if that's the right amount for you to be paying.
Cool. Yeah. So Michael is a client. You can just reach out to his portfolio manager and ask these questions, right?
Mm-hmm.
Since anybody that's new here and you don't know, you get a portfolio manager, you have somebody managing your money, an asset manager, not a property manager, an asset manager of your returns. We all get that as clients here. All right, man. We got Joe B1, Joe Bussy.
Love it.
All right. He's asking, wondering how tax brackets affect returns, or is there an episode that explains the tax savings profit center?
Well, I know that there's going to be a class that's going to explain that sometime in the very
Class,
near
well,
future.
class coming up.
Yeah, where do we want to start there? How do tax brackets affect return? So should we talk about tax savings overall, or should we talk about specifically tax brackets? Why don't we start the big picture of tax savings here?
Okay.
Because you know I love tax savings.
I know
you know any opportunity I have to talk about.
You just rattled the hornet's nest.
So, taxes, the taxes you pay on income, no matter what asset you're investing in, right? You earn income and then you have to pay taxes on it. Well, in most asset classes, you don't get to write off the expenses that were incurred to generate the income. Like, for example, if you earn a dividend in the stock market, you don't get to write off the expenses to buy the stock.
Your subscription to the Wall Street Journal.
You don't get to write
can't write that off.
You don't get to write that off, right? You don't get to write off the mileage that you drove to go to lunch to talk about it with your financial advisor.
True.
You don't get to write these things off for a dividend, right? But in rental properties, you get to write off almost everything that was required in order to generate the revenue, the rent, right? So
a trip to Jacksonville to see the property.
Yeah, there you go. You want to take a trip to Jacksonville to come see the property, right? Go on the next Not Your Average Investor tour, right? Well, you can write that off. Of course, you've got to spend time with the property management company. You've got to do this by the books from an accounting perspective. I'm not a CPA. If you want to ask more about that, go talk to your CPA. But I can tell you that writing off a trip to go and manage your properties in a different location and also spending some time to go hang out with us or go to Disney or whatever you want to do, perfectly possible. Yeah. So you get to write that off, right? You get to write off your property management fees. You get to write off your interest that you pay on your loan, your property taxes, your insurance costs, the repairs that may be necessary at some point. They definitely will be necessary, right? You get to write off those costs. I mean, there's a whole bunch of costs that you get to write off, and those are just some of them. So what that does is that leaves you with even though you're earning tens of thousands of dollars in gross rental income, the amount that you're paying taxes on is that net rental income, which is cool. That's different than other asset classes. So that's a win. But if that was the only win in rental properties when it comes to tax savings, I wouldn't get nearly as excited as I do. So the downside, like, we all love write-offs. Those are all just write-offs I talk about. We all love write-offs. Everybody loves write-offs. What's the problem with a write-off, Pablo?
That you got to spend money to get a write-off.
You got to actually spend the money to get a write-off. You pay the money, and then you get really excited if you get to write it off. What if there was this awesome way where you didn't have to spend the money, but you still got to write it off? Would that be pretty awesome?
Yep.
Yeah. That would get you super excited to where on Friday nights, all you want to do is learn about tax savings, right?
Clearly.
Yeah. Well, that's what we have in rental properties, and you all are able to take advantage of this. What I just described there in a non-CPA way, I just call that like a non-cash write-off. And that's not like a CPA term that I know of. This is just what makes sense to me. Like, I don't have to spend the money and I get a write-off. That is called depreciation from a tax perspective. What the IRS allows you to do is it says, listen, you have a building, over time, it's going to depreciate. Things are going to break. And so what they do is, over a period of time, they allow you to take a write-off, whether or not things break. You're just able to depreciate the building. And so this write-off equates to $3,000, $4,000, $5,000, $6,000, $7,000 of taxes that you're able to write off in that year. Even if you didn't spend any money on a repair, you're still able to write that off. So if you have $3,000, $4,000, $5,000 of rental income coming from this property or from any of your properties in other cities and other portfolios, another portfolio that you have with JWB, you're able to write off all of that income. You don't have to pay the taxes on it, even though you earned it. And that at the heart is this beautiful tax savings that we keep talking about. You get all the tax savings of writing off all the normal stuff that you had to spend the money for, and then you get to write it off. And then there's this extra special benefit, which is called depreciation from a tax perspective. I'm not talking about depreciation of the market value. That's you can have your market value going up and appreciating and still take depreciation from the tax perspective.
Yep.
And that depreciation is what saves you tens of thousands of dollars over a full market cycle.
Got it. And we learned in the class, which you will all have access to, is for a limited time, is the fact that like that depreciation, maybe if you have a bad year, 1 year, you can save that depreciation to the year that you have more income and stuff like that, right? Like
Yeah.
real flexible. That's a really good explanation of the tax write-off, the tax savings profit center GC. I believe that Joby One was asking, how does someone's income bracket affect the actual returns, right? Like if I'm let's say I'm a professional athlete, right?
Mhm.
I'm in the highest income bracket versus I'm just medium balling out here, Pablo.
Yeah.
Being in different brackets, does that affect your return on these investments?
With taxes, like you would imagine, all things can affect your specific tax savings.
Mhm.
So, the estimate that we put forth on your tax savings is the best that we could do for the majority of our clients. Your situation might be slightly different. You might get more tax savings, you might get less.
Yep.
But in general, the way that this thing works is, when you pay your federal income taxes, you have different brackets. So you pay 20% up to X amount of dollars.
Mhm.
And so you earn, I don't know what the bracket is, but you earn, let's call it $50,000,
Whatever.
$20,000 or
Mhm.
whatever. You pay, a low percentage for that low income that you earn. Everybody does.
Mhm.
And then if you earn more than that, from 20,000 to 50,000, you might pay 23% of so everybody's income steps up, and then you pay that additional percent on that additional income, and then up and up and up. So when you get to the actual top tax bracket, just the portion of your income, which is in that top tax bracket, is taxed at the highest rate. I don't know if that makes sense. Does that make sense so far?
Yeah, the percentage that comes in above a certain amount gets taxed at the highest rate.
Right.
When everything up until that still gets taxed at a lower rate.
Yeah. So like
Okay.
if you say, I think the top tax bracket's like 38% right now, 39%, 37%. I don't know what it is. But if you're in that top tax bracket, you're not paying 38% on all of your income.
Mhm.
It's just the income that is the highest amount.
Yep.
So the reason that's important to understand is when you go to rental properties, typically this is not your active income. This is not your main source of income. This is typically, you would think about it as the last stack of income on top of your other income.
Mhm.
So this income is going to be taxed, otherwise would be taxed at the highest rate.
Yep.
That you would qualify for.
Yep.
And so in that case, what you want to do is look at your top tax bracket that you are in right now,
Mhm.
and then look at what your income would be and your tax savings would be from this rental property, and assume that it's that top tax bracket, because this income would be at the top of the stack of your income. And so that's what we do. And so for the majority of our clients, we estimate at 35%. That's right in between the top tax bracket and the one below it, I believe. And then this is over a 10-year hold too. So we estimate, and a lot of our clients become, wealthy over time, especially a 10-year hold or a 20-year hold, like many of our clients are. So over time, they are likely going to continue to gain in their tax brackets. We don't exactly know what the tax bracket is going to be in 10 years, but overall, that's how we get to an estimate of 35% of tax bracket, which we use to estimate what your tax savings is. I don't know. I know that got really technical.
No,
How'd that go?
I think you're good. I think basically the answer to Joby One is the idea that yes, your income bracket, your tax bracket does affect how much you're going to pay taxes on the revenue that you're creating from this, or when you exit or whatever. That being said, it sounds like in these estimates, you're already estimating people at one of the higher tax brackets already, right? Like a blend between the highest and the second highest.
Right.
So therefore you could still count on these numbers, most likely, yet they're very personal. So you got to like do your thing with your CPA and all that other stuff, right?
Yeah. It's on a year by year basis, really hard to estimate exactly what your tax savings are going to be on your rental properties, because it's dependent on your rental income, your rental expenses, your tax bracket, how much money you earn. So it's really hard to do that. That's why we look at it over a 10-year window.
Yeah.
And over a 10-year window, you're probably going to be able to use all of that depreciation And then, over time, many people continue to gain in their tax bracket. So that's why we feel good about 35% as an average across the 10-year window. And that's probably the best way to look at it from a tax perspective.
Got it. JWB says, thanks for explaining in detail. It seems like the tax profit center is always glossed over. Well, we're here for you, Joe.
There you go. You need tax savings explained in detail. I'm your guy.
JWB, let me just tell you something. If you're ever going to go for a run with Gregg and you really want him to set the pace and just gallop like a gazelle, start talking taxes, man.
Baby.
Our fastest runs. I get him talking taxes. All of a sudden we're 4 miles in and I don't know what happened to my legs. I can't feel anything. And he's just like going and talking and just like vibing about it, man.
But you saved 30 to 40% somewhere after that run.
I did. A couple of great community here contributions. The number one, Gregg Stone.
The better
Gregg coming in from New Jersey said, did you mention 1031 exchanges as far as like tax savings go?
Yeah, it's another great tool to use for saving on taxes. A 1031 exchange allows you to sell your property, but not pay the taxes on that, whether that is at your federal income tax bracket or whether that's capital gains. If you've held it for a long time, you don't have to pay any of that right now. So when we're talking about ways to defer taxes, it's an incredibly powerful strategy. I've used it many, many times in my own portfolio, and a lot of our clients do as well. And it's also a great, turnkey rental properties with a vertically integrated provider like us are a great solution for those who are thinking about doing a 1031 exchange. Because most times when you're doing a 1031 exchange, it's hard for you to follow the rules. There are rules for how many days you have to identify what properties you want to purchase with the proceeds of the previous sale. And there's days you only have 180 days to actually close on the property. From the previous sale, you have to identify in 45, and then you have to close within 180. So it's hard for people to do that. Hard for anybody just to randomly buy a rental property in 6 months from the time they start thinking about it. But with a provider like JWB, we have inventory here, like you can see on the property of the week now. We can fulfill those requests, and folks don't have to worry about those timeline requirements.
The white glove service of JWB. I love it, man. Matthew Edwards, who did not check in the roll call, but is clearly a savvy real estate investor. He's come up with some good stuff here in the chat. First, when we were talking about inflation, but now he's saying, if you qualify as a real estate professional, you can write off excess losses from your properties against other types of non-real estate income, such as W-2 income from a job or investment income from non-real estate investments. What do you say about that, John?
I love it. Matthew is absolutely a savvy investor, I can tell. Because what I try to show you guys is the value of these tax savings, assuming you don't have any special things going for you. It's just the bare bones. This is what it's like to be a rental property investor if you don't have any special things that you can qualify for. But it gets a whole lot better than what I've just been describing. Talked about 1031s. Well, what Matthew's talking about here is if you are a real estate professional, you can write off your depreciation and your other losses on your passive side of your income against your active income. Normally, for all of us, we're only talking about writing off our passive losses, depreciation and other things, our passive losses against our passive gains. If you're a real estate professional and you qualify, then potentially you can take your passive losses, including depreciation, and write it off against your active gains, your active income. And that's really powerful. Now, most of our clientele does not want to be an active investor, meaning an active real estate professional. They want to be passive with this. So I won't say that this applies to everybody out there. You have to spend a certain number of hours in your real estate business every year and other things to qualify. So it may not apply to you, but some of you, it already does apply for because you use us as your passive rental property portfolio while you're off making your own real estate investments in California, New York, Virginia, wherever you are. And so that's when it can work really, really well.
Yeah, there's definitely. So I remember when we first kind of started talking about who you serve, right? There is people like me that just, I can't be bothered with it, but I want to invest in real estate.
Right.
So you handle everything. And then there's a large segment of the population as well that are people that are active. They're doing flips. They're making deals out there, but they know that they don't want to be doing deals all the time forever. So they're taking the profit from some of the deals, putting it in somewhere where you can preserve capital, turn equity into income, beat inflation with that money. So they're taking active deals, putting it into passive investments, those folks have even more tax advantages as well.
100%.
Yeah, Michael Santoris is saying the IRS definition of a real estate professional has their real estate investments treated as active income. To achieve this definition, you must spend at least 750 hours per year working in the real estate industry. He also comes up with some other good stuff here. Greg, as you said, the land cannot be depreciated. So one of the advantage of investing in Jacksonville is a good portion of that $275,000 purchase price is depreciatable over the next 27 and a half years.
That's a very good point. So, this is not a place like Northern California, where land costs are a significantly higher percentage of your overall investment. Relatively speaking, land is inexpensive in Jacksonville, Florida. The reason that's important is because you can't depreciate land.
Yeah.
You want to have more stuff to depreciate of the total amount that you spend on a property, and you get that here.
Yeah, you depreciate the materials inside the home that is on the property, right? Or in like the materials of the home, the construction materials. The building. And in places like California, you buy $1 million house and it's like a shack somewhere.
Exactly.
But the price of the land is insane. Here, a bigger percentage of it is the home itself, because land is not as expensive.
That's a good little nugget that we've never really talked about and exposed here on the show. But yeah, that's
nugget.
Look at the machine over there, the referral machine over there coming up with that.
I love it, man. I love the value of our community, man. Always coming up with good stuff. Eddie Harris from Hot Atlanta says, hey guys, when your properties are within a retirement account, you don't get the tax savings initially, but how does that benefit when you start taking the money out? Thanks, and keep up the great work.
Eddie Harris from Hotlanta. Great question, my friend. So, at the end of the day, we want to be in assets where they either grow tax-free or they are tax deferred. That's the end goal here. And when you buy rental properties outside of a retirement account, like you have purchased yours just personally, right?
Correct.
You get to that place by using depreciation. You get to the place of deferring taxes by using this amazing thing called depreciation from a tax perspective. But the end goal here is no matter how you get there, meaning no matter how you get to a tax deferred environment or a tax-free growth environment, get there, right? For our friends who buy properties in their retirement accounts, you already are there because you're buying a property either with tax-free growth, like a Roth retirement account, or you're buying it with tax-deferred growth, which is in your traditional IRA, 401k, solo 401k, what have you. So you're already there. So what the IRS does not allow you to do is to double dip. They don't allow you to be in a retirement account and then also get the depreciation from that. So some people might say, oh, geez, well, I don't want to invest in a retirement account, buy a property in a retirement account because I don't get the depreciation. And I think they're missing the point. You already are there because you are buying it in a retirement account. You are getting the same type of depreciation kind of benefit there as far as deferring taxes as you do outside of it. So a little bit of a misconception for many people. That's certainly not a reason to avoid buying properties in your retirement account that you don't get the depreciation. You already got it. Way to go. You're already there. And then I think he asked, how does it affect it when you take the money out?
Yeah.
Well, and this comes back to, again, the type of retirement account you're investing in. If it's a Roth IRA or 401k or a Roth retirement account, then you paid the taxes day one, and then it allowed you to grow that retirement account and the value of those assets inside that retirement account. So this rental property continue to grow over time. And then when you go to sell the property, you don't have to pay the taxes on the sale either. That's the beautiful thing of a Roth. So that's a huge win. You're still winning if it's a traditional retirement account as well. You don't pay the taxes in the beginning. So you have more resources to invest. You don't pay the taxes as that's growing all along the way until you're 59 and a half or later. You don't pay the taxes, which is huge. And then when you reach 59 and a half or after that, and you want to take you want to sell the assets and you want to distribute the funds, you then have to pay the taxes. So neither way are you getting out of taxes, but you are minimizing your taxes by using either one of those strategies. And if you can find a way to minimize the tax burden, you are going to be so much farther ahead than your friend who says, oh, I'm just going to pick the I'm going to pick the stock winner. So many people focus on picking the stock winner.
Yeah.
If people would just focus on how can I minimize my tax burden over 30 years, you're going to be so much farther ahead. And both of those strategies allow you to do that.
There you go, buddy. I love how your eyes light up when you talk taxes. Ken Moline also says another one here. Another tax benefit brought to our attention by our CPA tax preparer. When you take out a jumbo reverse mortgage on your principal residence, the interest that you pay on that loan cannot be deducted from your income tax. But if you use any or all of the cash generated by the reverse mortgage to invest in real estate products, that interest can be deducted as a business expense. So
interesting.
Ken's always coming up with great
Interesting.
stuff, man.
Never thought about that.
Yeah. And then we got Kathy Cepeda in here. Kathy, new name?
I know Kathy's name.
Yeah.
And but I don't think she's been here for in a hot minute. So
there you go. Cool. Got
great
it.
to have you, Kathy.
Welcome to the show. She says, I came in late and didn't get to see the properties that were demonstrated. So here we go. I displayed it as soon as that question came in, Kathy. And she's asking, can you show us an example of a property that is below 200K? Gee, are there any?
Tough to do that.
Right now?
Tough to do that these days, Kathy. You know, home prices, as you know, over the last couple of years have gone up 40% in Jacksonville and many places in the country. So very, very difficult to have a turnkey property at $200,000 or less. The way to achieve that would be if you want to do all the work yourself and go and try and find an undervalued property, maybe you might be able to do it, or you're going to go into a neighborhood that is not a neighborhood that's going to be built for risk mitigation. Meaning, you know, you go into some of the lower income neighborhoods in Jacksonville and you can find lower purchase prices than 200,000. But that's where you deal with excess maintenance and vacancy cost, and then some safety issues as well. So yeah, you want to be just below that median home sales price. And that's why that $275,000 range is, call it roughly, is more or a little bit less there is that sweet spot right now for Jacksonville turnkey properties.
Yeah. So you want to be in lower income neighborhoods, but not the lowest income neighborhoods, because those are the ones that tend to have that increased vacancy rate, violent crime, stuff like that.
Yeah. I'd say, you know, below middle income, workforce housing, that's the type of neighborhood you want to be. Start to get to low income, and that's where the risk return ratio just doesn't seem to pay out.
Got it.
Even though the sticker price is attractive, it doesn't play out there.
Got it. Kathy says, great. Thank you, man. GC, good stuff, man.
This is awesome.
Good to be back in the studio. Good to have
Really
the whole team back together again in here. You know, we had the attendees go up as the show went off. More than 52 people were here with us today. Just never goes unnoticed. This idea that our community takes an hour out of your day on a work day to come here and give us great advice, you know, like ask great questions, be a part of this thing, help each other out, make it easy on us. I just thank you so much for being here. Great for me to be back. I know that I miss it when I'm not here. I heard that you did okay on Tuesday without us.
Tell you what, the community helped
a
bunch. Man, we had some great questions that folks were firing in. I felt the love and the support. I couldn't have done it without you guys. So, you know, it was, don't do that to me again. Don't do that.
I don't
Especially
do it.
Madison too, right? You both were not here. I was like, oh goodness, how am I going to pull this off? But we did all right.
Awesome. Well, we're officially, you know, we take the feedback to the community. People were asking about Blackstone last week. This week, you're talking about these new mortgage rules. We're going to lead the show. Next week is the Not Your Average Insights. We'll come prepared to talk about those things. So show up with your own ideas, be part of the dialogue for the Not Your Average Insights that we're going to have on Tuesday. But the one thing that I ask you to do is don't be average. See you next week.
See you, everybody.